Imagine a slow leak in a tire. It costs $20 to patch, but you don't have $20. You have rent due in 3 days, and your bank account is sitting at $12.50. So, you ignore the leak. You refill the air every morning at a gas station that charges $1.50 for the air pump. 2 weeks later, the tire blows out on the highway. Now, you need a tow truck. That's $200. You need a new tire. That's $150. And because you missed your shift at work while waiting for the tow, you lost $100 in wages. The $20 problem has become a $450 crisis. This is the hidden mathematics of poverty. It is a compounding interest on misfortune. We often think of wealth as simply having money, and poverty as simply lacking it. But that definition misses the mechanical reality of how our economy functions. Poverty isn't just a lack of assets. It is a surcharge on existence. The system is designed in such a way that the less money you have, the more you pay for the exact same goods and services as everyone else. In the Discworld novels, the author Terry Pratchett described this perfectly through the Vimes Boots Theory of socioeconomic unfairness. The theory goes like this: a rich man can afford a pair of $50 boots that last for 10 years. A poor man can only afford $10 boots that last for a season. Over 10 years, the rich man spends $50 on footwear and his feet stay dry. The poor man spends $100 on boots, $10 at a time, and his feet are always wet. This isn't fiction. This is the operational reality of the global supply chain, and it starts in the most mundane place possible, the grocery store. Walk down the aisle of any supermarket and look at the toilet paper. If you have $50 to spare, you buy the massive bulk pack. The cost per roll drops to pennies, but if you only have $5 until Friday, you physically cannot access that bulk price. You are forced to buy the 4-pack. The unit price, the actual cost of the product, is nearly double. This applies to rice, laundry detergent, diapers, and canned goods. This is known as the poverty premium. It is the fee you pay for the inability to interact with economies of scale. When you are poor, you are forced to be an inefficient consumer. You are buying the smallest, most expensive units of everything forever. But the grocery store is just the surface. The real extraction happens in the financial system. To be wealthy is to have banking be free. If you keep a high minimum balance, banks waive your monthly maintenance fees. They give you premium credit cards with cashback rewards. Effectively, the bank pays you to use their money. Now look at the other end of the spectrum. If you live paycheck to paycheck, you are high risk. You likely don't meet the minimum balance requirement, so you are charged a monthly maintenance fee, usually around $12. That is $144 a year simply for the privilege of holding your own money. Then comes the liquidity trap. Let's say a bill hits your account a day before your paycheck lands. You go into the negative by $5. The bank doesn't just decline the transaction, they often process it and charge you an overdraft fee of $35. You effectively just paid a 700% interest rate on a $5 loan that lasted 24 hours. In 2019, banks in the United States alone made over $11 billion in overdraft fees. The vast majority of that revenue came from customers with balances of less than $350. The banking system is effectively subsidized by the poor. The free checking accounts and credit card rewards enjoyed by the middle class are funded in part by the penalties levied on the working poor. And if you step outside the traditional banking system, the terrain gets even more hostile. Consider the payday loan industry. If your car breaks down and you need that $500 immediately, and you have no credit and no savings, you go to a lender who offers you cash today in exchange for your paycheck next week. The annual percentage rate, or APR, on these loans isn't 5% or 10%. It often sits between 300 and 600%. If you can't pay it back in full in 2 weeks, and most people can't, because if they had extra money, they wouldn't have needed the loan, you roll it over. You pay a fee to extend the loan. Soon, you have paid more in fees than the original $500 you borrowed, and you still owe the principal. It acts as a financial event horizon. Once you cross it, the gravity of the debt becomes so strong that escape is nearly impossible without external intervention. But money is only one currency. The other is time. And it is incredibly expensive to be poor in terms of time. Wealth buys efficiency. It buys a washing machine in your house so you don't spend 3 hours at a laundromat. It buys a reliable car so you don't spend 2 hours commuting on a bus system that requires 3 transfers to go 5 miles. It buys healthy, pre-prepared food so you don't spend an hour cooking after a 10-hour shift. When you are poor, you pay for your lack of capital with your time. You wait in lines. You wait for the bus. You wait at the Social Security office. You wait for the laundromat cycle. This creates a vicious feedback loop. Because you are time poor, you cannot invest time in things that might get you out of poverty, like education, networking, or even just searching for a better job. You are too busy handling the immediate logistics of survival to strategize for success. There is also a biological tax. Cheap food is energy dense but nutrient poor. Processed carbohydrates and sugars are the most calories you can buy per dollar. Fresh vegetables and lean proteins are expensive. Over years, this diet leads to chronic health issues, diabetes, hypertension, heart disease. If you are wealthy, a toothache is a nuisance. You go to the dentist, get a filling, and move on. If you are poor, a toothache is a catastrophe. You can't afford the dentist, so you wait. The infection spreads. You miss work because of the pain. Eventually, you end up in the emergency room, the most expensive form of healthcare possible, where the tooth is pulled. You have lost a tooth, lost wages, and gained a massive medical bill, all because you couldn't afford a $100 preventative cleaning. We must also look at the housing market. Rent is the ultimate example of paying for something without gaining equity. A mortgage payment is often cheaper than rent for a comparable property, but obtaining a mortgage requires a down payment and a credit score, barriers that require capital. So the poor pay rent. They pay off their landlord's mortgage. They generate wealth for someone else, month after month, year after year, with zero asset appreciation for themselves. When we zoom out, we see that the system operates on a fundamental paradox. Risk is expensive. Because the poor have no financial cushion, they are viewed by the market as high risk. Therefore, the market charges them a risk premium on everything: loans, insurance, even utility deposits. But charging them extra depletes their resources further, making them even higher risk. It is a self-fulfilling prophecy engineered by actuarial tables. The tragedy is that many people believe poverty is a result of bad decision-making. They look at a poor person buying a slightly more expensive meal or a small luxury and say, if they just saved that money, they wouldn't be poor. This ignores the psychological toll of scarcity. Behavioral economists have found that poverty imposes a massive cognitive load. When you are constantly calculating whether you can afford gas to get to work or milk for your kids, your bandwidth for long-term planning drops. Your IQ effectively lowers in the moment because your brain is running a background process called survival that uses up all your RAM. The bad decisions are often just the result of a brain exhausted by the impossible arithmetic of staying afloat. So why does this matter? Because it exposes a structural flaw in the concept of social mobility. We tell people that if they work hard, they can rise. But we rarely acknowledge that the ladder is greased. The bottom rungs are not just lower, they are stickier. The gravity is stronger. It matters because this inefficiency is a drag on the entire economy. When millions of people are spending their money on late fees, interest, and preventable medical emergencies, that is capital that is not being spent on innovation, education, or genuine asset accumulation. It is deadweight loss. The next time you see a price tag, realize there are two prices. There is the price for those who can afford to pay it up front, and there is the price for those who can't. The most expensive thing in the world is not a luxury yacht or a private jet. The most expensive thing in the world is having nothing.